Good morning, everyone. Thank you for taking the time today. My name is Stephen Jensen. I lead the Diversified Industries group in Canada for BMO's Commercial Bank. The purpose of today is to bring BMO subject matter experts together to ensure that we're sharing the best information to our clients, to our advisors, and our friends. It's going to be an interesting conversation today because it's a very dynamic conversation. But before we kick off, I just wanted to inject a little bit of positivity into the conversation. Over the last month, the last several months, I've been, of course, talking to customers every day. And I'll tell you what, the one thing that continues to impress me is the resiliency and the fortitude of the business owner. If there's one thing that I learned through the pandemic was the entrepreneur and its ability to innovate, diversify supply chains, and manage risk is always moving. And I know in the current environment, we're going to continue to see that in innovation and that resiliency. It's a privilege, and it's a privilege for the entire BMO team to be able to work with business owners across the country. I'm going to jump into introductions. I'm really excited for today. We have Shelly Kaushik, one of BMO's senior economists who conducts research on the Canadian and regional economies, as well as providing fiscal policy and country risk analysis. We also have Jason Giovannetti, who's a director in BMO Capital Markets and Trading Products and works with clients to manage their FX exposure and risk. We have Swaroop Shenoi, who's a VP in BMO Capital Markets, Global Transaction Banking, and offers trade finance insights and solutions to our commercial and corporate clients. I'm confident we are going to be able to share best practices, tips and tricks that you could use, or at least start the conversation with your BMO relationship manager to explore all the different ways that we can help you as you navigate the current environment. Shelly, we're going to kick off with you. I wouldn't mind you spending a little bit of time and walk through, in my notes it says a week here, but I feel like I should say 24 hours or the last 48 hours, and what has changed with the US threats on Canadian and Mexican imports, and really set the stage of the implications on the Canadian economy. We'll start there. Shelly, over to you.
Thanks, Stephen. Hi, everyone. Thanks again for joining us. Now, like Stephen said, this is very, very much a dynamic environment. Things are changing by the minute, let alone by the hour or by the week. But really, it's something we've been experiencing for the last month or so, at least at this point. Sorry, so just to back up. So when Canada and Mexico and China were hit with tariffs in early February, Canada and Mexico negotiated 30-day reprieves for themselves so that their governments could make enough progress to satisfy President Trump on securing their borders, especially when it came to limiting the flow of fentanyl. But that 30-day deadline ended on March 4th. So now we've got 25% tariffs on all Canadian and Mexican exports to the US, except Canadian energy and critical minerals, which themselves have a 10% levy. And then yesterday, the White House announced a 1-month exemption for the auto sector. That includes auto parts, which is a good step. We do know that, of course, the auto manufacturing sector is very, very highly integrated across both the US-Canada and Mexico-US borders, with parts going back and forth quite a number of times. So actually exempting not just autos, but auto parts is a very good first step, but really a 1-month delay it's kind of just pushing the impact out by a month. It's not real relief for the sector here. So I will also note that U.S. Commerce Secretary Lutnick also suggested about an hour ago that President Trump would also announce a 1-month reprieve on all goods covered by the USMCA. It's very unclear at this point what exactly that means, whether it's goods specific to the USMCA, whether it's all goods covered by, or all goods, sorry, sent by Canada and Mexico. Details very sparse at this point. That could change the game entirely, but at this point, again, it's very, very early. It's hard to tell whether that will actually be announced today, let alone what the actual details are, whether it's really just a 1-month delay like we saw last month, or whether it could potentially start to show, some progress in negotiations. So taking a step back from these, hourly updates that we're seeing here, I think the fact is that Canada is under these unprecedented tariffs. The scale is unprecedented, especially just how broad-based they are. The fact that these tariffs are on two, I guess, of the most closely tied economies in the world. And the fact is, though, that they were announced previously. They were announced a month ago, so we are in a situation where businesses, consumers, policymakers, they have had some time, of course, to get prepared. Now, for its part, the Canadian government is, for now, going ahead with previously announced countermeasures. So that's 25% tariffs on $155 billion of U.S. exports into Canada. Now, $30 billion of those goods that are now under counter tariffs, those are already in place. The rest of that is scheduled to come 21 days later, although the latest development on a potential 1-month reprieve, Prime Minister Trudeau has indicated that the rest, that second round of countermeasures, may be delayed, assuming that, again, Canada does get broad-based relief. Now, the government is also challenging these tariffs under the WTO and USMCA. That, I would say, is largely a symbolic move. It's unclear whether a ruling from either organization would have any real impact on the US administration. But on top of that, we've also seen a number of additional measures by the provinces. So, for example, probably the largest one was that the province of Ontario announced a 25% export tariff on electricity exports to the United States. We've also got a number of non-tariff measures across all provinces and territories, like limiting U.S. alcohol sales in liquor stores, tweaking provincial procurement directives, in many cases outright banning U.S. companies from those directives. And I just want to also add that Mexico hasn't yet announced any countermeasures this time around. We are likely to hear more in the coming days. President Sheinbaum is scheduled to have a call with President Trump today. But of course, a lot of this will largely depend on whether or not Canada and Mexico do get these 30-day reprieves. Now, all of this is happening in a pretty good news story for Canada. The domestic economy in Canada is actually firming quite well. In fact, the latest figures are from last week. They had fourth quarter growth accelerating to a solid 2.6% annualized rate. And we also revised up our call for growth to 1.8% for 2025 as a whole. So, of course, this was all pre-tariffs, but again, the domestic picture is actually one of pretty good strength. It does look like past rate cuts have led to a firmer labor market, all of that helping to support growth. Now, we know that Canada is one of the most interest rate sensitive economies in the world, and we saw consequences of that when the bank tightened rates just a couple years ago, and now, of course, we're seeing the other side of that coin. But the tariffs, like I said, are a game changer. The actual impact on the Canadian economy is going to depend on a number of things, the timing of any exemptions, exactly how long the tariff measures last. But our initial read is for these tariffs, the 25% tariffs, including 10% on energy, will remain in place for a year. Our first take was to lower GDP growth to just 0.5%. Again, that's from 1.8% in 2025 to 0.5%. So again, while the economy is starting from a relatively solid position, I think at this point we're looking at Canada potentially facing a moderate recession. But again, anything can change very quickly. These forecasts could change as quickly as this afternoon. So I'll leave it at that for now.
Excellent. Thank you, Shelly. And I don't think Shelly has gone to bed in a week right now. And I think the words if and might have probably increased exponentially in the world. Shelly, I wouldn't mind digging a little bit deeper and maybe going through the implications on the headwind on the economy. And how do you think the Central Bank of Canada will respond in that environment?
Yeah, so if we take a step back, we know that tariffs and associated countermeasures, they do two things fundamentally. On one hand, they raise prices, that's the direct impact. It could be just a one-time increase. which would mean that they would just flow through inflation calculations and come off in a year. But if we do face additional moves on tariffs, so whether it's exemptions or additional tariffs, or if businesses use tariffs as a potential cover to push up prices even further, that means that the inflation risk could last longer. So we've got some meaningful upside risk to inflation, at least in the short term. But on the other hand, they also make it harder for businesses to compete across borders and for consumers to buy goods across borders. So, because Canada relies so heavily on trade with the United States, that impact, that economic impact, is large enough that, again, it could put the economy at risk of a recession. So, on net, you have these upside risks to inflation, which then add upside risks to the rate outlook against this downside risk to growth, which is pushing down the rate outlook. So, on net, we do think that the economic hit will be larger, which means that rates are likelier to fall faster and further than what would have otherwise been the case. Exactly how much is the $1 million question. And for that, again, the outlook depends on a number of things. So exactly how much of that additional tariff cost will be borne by businesses versus consumers, how long the tariffs are in place again, and whether Canada is able to negotiate further exemptions or reductions for more sectors. But for now, again, initial estimate is for another 50 basis points in rate cuts if tariffs are in place for a year. So that's, again, this current situation as of right now, which is 25% tariffs on all Canadian exports, except 10% on energy and critical minerals. That, again, a very initial read, an extra 50 basis points of rate cuts. That would bring the terminal rate down to 2.0% by July, compared to 2.5%, which is what we had previously expected, even just earlier this week.
Excellent. Thank you, Shelly. And maybe I'll just push the linkage and put you in the hot seat a little bit more. And maybe if you could just draw the linkage directly to the Canadian dollar and expand on that.
Yeah, I mean, the Canadian dollar is, like many currencies right now, is of course facing its fair share of volatility right now. We do know, of course, that some of this uncertainty has already sort of been priced into what is already quite a weak Canadian dollar. But I think there is some, or at least was some, element of not believing that the tariff threats would actually be realized even now. I think there is still some hesitation there. But regardless, I think now that they're here, we do have, of course, this significant weight on Canada's broad economic outlook. And then, of course, we have this risk of greater divergence in policy rates now that the Bank of Canada has even more pressure to cut further compared to the Federal Reserve, which is facing many of the similar risks and many of the similar questions. But it is a much smaller impact on the U.S. economy than it is on the Canadian economy, just the impact of tariffs. And so on net, again, less pressure for the Fed to cut further thanks to tariffs, but much more pressure for the Bank of Canada to cut further. So that policy divergence, again, is at risk of widening even further. So both of those things together, that uncertainty and that policy divergence, just put additional downward pressure on the loonie. So at this point, again, very, very, very much in flux, especially if we get this exemption in a month or for a month. But for right now, we are expecting the loonie to average just over 149 by the fall. At this point, again, very likely to change very quickly.
Going to change very quickly. I think I'm hearing a lot of that too. This is a perfect, thank you, Shelly. And this is a perfect segue to bring in Jason. And Jason, I wouldn't mind from your perspective if we could just kind of step into the shoes of our customers who are importers and what exactly it means for them.
Yeah, I mean, we're having conversations on an hourly basis with our partners. They're definitely feeling some pain, and there's definitely a lot of fear. To kind of put that into perspective, the Canadian dollar, since the U.S. elections, lost about 5% of its value. It's actually lost more than that because we saw a run-up in the U.S. dollar heading into the election, but since the election, it's lost about 5% of its value. I mean, Shelly just mentioned if these tariffs are kind of a long-standing sort of thing, we're talking about 149, 150 in dollar Canada. That would be about a 9% depreciation in the Canadian dollar. And then, I mean, if you really want to talk about absolute worst-case scenarios, we can look back at the dollar Canada highs from 2018 north of 162. That would represent a 16% depreciation of the Canadian dollar just since the election. So bringing it back.
Hey, Jason. We're just noticing we're getting some technical mic feedback on you. So we're just going to pause you for a sec while the tech team figures out your audio, and we're going to pivot the conversation and bring in Swaroop. And Swaroop, again, is our trade finance specialist and could kind of, I know we weren't able to dovetail some of Jason's commentary, but we'll get it in there. So Swaroop, I'm going to pass it to you. And maybe if we could go into kind of the impact on trade risk with clients importing from the U.S. Over to you, Swaroop. And don't worry, Jason, we're going to get you fixed up and we're going to get you back into the conversation. Swaroop?
Thank you. Thanks, Stephen. So yes, the input costs would go up for clients that are directly impacted that are going to be importing from the U.S. And the idea is that a lot of the times these are direct costs that can be assessed, but there's also a lot of indirect imports that clients may not be able to evaluate as easily. Shelly earlier mentioned about the automotive supply chain, and most of the components of the supply chain move across multiple times the US, Canada, and Mexico borders. So the tariffs sort of multiply to that effect, and those are a little bit harder to assess. But all to say that the input costs will go up, which have a high probability of impacting the profit margins. A lot of the times, it may be possible for the clients to pass these on to end consumers, but the industry dynamics and competitive forces may not always allow them to do that. So there's a chance that they may need to pivot and follow other strategies. The good news is that the initial $30 billion tariffs that Canada has announced appear to be on goods that have alternatives or relatively easier to find alternatives. And so Canadian importers may be able to use that as leverage and find other options. The pain may be more on the Canadian exporters on those transactions, but less so on the Canadian side. The second tranche, however, which is expected to go live in the next 21 days, is going to be more broad-based, and that could have some more pain on Canadian importers.
Excellent. Thank you, Swaroop. I wouldn't mind pushing you a little bit and sharing some of the intelligence. You're talking to our customers every day and helping manage strategies. What would be some of the key activities that our clients right now, what industry is doing to minimize this risk?
Yeah, for sure, Stephen. So the biggest and the easiest way for clients to obviously accept this import risk is to pass this on directly to consumers. That's going to lead to inflation, obviously, in the Canadian economy, and that's the most likely outcome. The other thing that the Canadian companies are doing is working collaboratively with their suppliers to split some of the higher costs. Now, this may or may not work depending on the industry, but that's one of the options. And I think the other option is really for clients to think of from a longer-term perspective, which is to evaluate diversifying their supply chains. This is not something new. Clients have always been trying to do this, and the need right now is even more so. And this is not going to be an overnight kind of situation, but clients have started these conversations with us. The good news is that there are a lot of options out there for clients to leverage as they talk through with their suppliers on or new suppliers, prospective suppliers on potential options. There could be scenarios where they're faced with working capital situations or risks that come with the new suppliers. And the good news is that we've been having several conversations with many of our clients, which include options to mitigate these risks and have working capital solutions in place as they have these conversations.
Excellent. Thank you so much, Swaroop. I know we're going to be hosting several sessions and ongoing sessions as we work through this. And I think the one thing I'd compel the audience to do is reach out to your BMO relationship manager and have that conversation and engage the expert Swaroop and his peers across the country, because we'd be more than happy to have the dedicated time with you to kind of go through that in detail and share some of those examples. Swaroop, thank you so much. I'm going to try and connect and see if Jason's audio is working and try him on and start with the conversation with the importer perspective. Jason, let's give it a try.
Can you hear me now?
We could hear you. Give it a shot, but there seems to be a little bit of an issue. But maybe give it a kickoff, and I'll stop you if it's not working.
Is this any better here? I don't think it's going to work.
Okay, excellent. Not a problem. We're getting a little bit of feedback on you. So if you could just put yourself on mute, that'd be great. Thank you so much, Jason. I'm going to go and keep the conversation with Swaroop maybe, and kind of go into how will this impact the trade risk and clients importing from the U.S. So kind of flipping the conversation from the other way around for those clients right now. Swaroop?
Yeah, I think you meant export, Stephen?
I did. My apologies.
Perfect. Yeah, no worries. Clients that are exporting, this is going to be a bigger pain point because, as we all know, the tariffs from the U.S. side are more all-encompassing, and they're going to impact a lot more Canadian companies than vice versa. To put things in context, U.S. is Canada's biggest trading partner. We exported 77% of all of our exports last year went to the U.S. And exports represent, or U.S. exports represent 20% of our GDP. So let that stay for a second. We've been having conversations with customers on various strategies, though, to deal with these tariffs. Some of these are more obvious, some not as so. But the big picture here is that there is no playbook here. These are unprecedented times. There are things that will change every minute, and strategies would change. But some of the things that clients are trying to do is, one is they're trying to work with their counterparts in the US who are importing to split the potential impact of tariffs, impact of the cost. This has obviously an impact on the end customer as well. And hopefully the idea is to minimize inflation risks on the other country. There's also the longer drawn out solution, which is exploring customers in other markets. Again, this is not something new. This has been, clients have always been trying to do this, but the circumstances today are imploring them to move faster on these strategies. And so dealing with new markets comes with its fair share of challenges, new customers, higher risks, jurisdictions, and there could be working capital impact as well, because their customers may want terms, or they may just use certain trade instruments that may have a working capital impact on our customers. But there are several solutions, as I mentioned, out there. We have different types of letters of credit. There are supply chain financing solutions that we can engage. And we've been having several conversations over the last few weeks with clients along those lines. And there's renewed interest on those. There's also an important partner that we work with, which is Export Development Canada. EDC is known to support exporters. They've obviously stepped up their game now that they have more programs in place. And we work with them closely to have conversations with these clients, and also to mitigate any impacts that these tariffs may have.
Excellent. Thank you, Swaroop. I wouldn't mind expanding the conversation and bringing Shelly in to kind of, I know the U.S. is the key focus right now, but I wouldn't mind expanding because China is an important piece of the puzzle right now, and that dynamic is changing very quickly too. And maybe talk about the implications and the impacts of China. Shelly, over to you.
Yeah, I mean, it's China, but it's also pretty much every country right now is worried, I would say, about getting caught in the crosshairs of these US tariffs. Now, China itself, of course, it was already hit with that 10% tariff in February. They didn't get a reprieve like Canada and Mexico did. And then they got an additional 10% this week. So that's brought the total tariff, at least in this round or two rounds, to 20% on top of any previous tariffs that were already imposed on Chinese goods from before February. Now, China has also announced its own very limited countermeasures, mostly targeting U.S. food and agricultural producers. But really, it's kind of the last thing that the Chinese economy needs right now. It has struggled to recover over the last couple of years, really since COVID. Consumer demand in China does remain quite soft. Incomes are quite soft. The crisis in the property sector is dragging on. Ultimately, I think these trade tensions have already made their mark even before the tariffs were in on external demand for Chinese goods. That said, over the last couple of years, I think China has been fairly adept at diverting some of its goods through third countries before exporting them to the United States in order to avoid some of these tariffs. So we'll have to see exactly how far that can continue with this latest round. And thankfully, I would also say the government also announced last night that it would raise its deficit target to now 4%, roughly 4% of GDP. Previously, it was less than 3%, so that's a pretty significant move. There does seem to be, a meaningful shift in appetite from Chinese authorities to now stimulate the economy, which is exactly what it needs, and what a lot of experts had been calling for a number of years. Like I said, this kind of sluggish domestic backdrop has been in place for a little while at this point. So really, we'll have to wait to see exactly how this plays out in the data. I will just note, and I think the main takeaway here is that China is coming into this tariff period from a place of more weakness than it had the last time around, certainly since the previous Trump administration's tariffs on China. Now, for now, we did cut China's growth outlook by another couple of tenths for the year. So we're looking at 4.3% growth for 2025. Again, that's just based on the latest round of tariffs. That's clearly below the government's target, which is for 5% growth. And it is, of course, very, very early in the year. It's only March, if you can believe it. So we'll have to see again how the stimulus plays out, how the tariffs play out. But I will just come back to my initial point that there are a number of countries that are really in the spotlight right now, not just given U.S. willingness, I should say, to tariff its trading partners, but also, of course, there's geopolitical risks with the ongoing war in Russia and Ukraine, as well as a number of conflicts, a number of government changes in a number of significant countries. So I will also just point out that elsewhere, the EU has also been singled out with a threatened 25% tariff, US tariff on autos and other items. Now, the ECB just cut by 25 basis points. That was widely expected this morning. The economy in general is fairly stagnant. And of course, the tariffs add quite a significant, meaningful risk. But there's also, again, a lot of moving parts, even just in Europe. So the largest economy, Germany, which had been up until recently the kind of the powerhouse of the euro area, has also stagnated quite significantly and has faced increasing fiscal pressure as well to stimulate the economy. And recently, they just had an election. The incoming administration, which is still yet to be kind of finalized and formalized, given that it will be a coalition government once again. But they have indicated this preference, or at least willingness, to lift or at least be more flexible with the debt brake. So that is potentially pointing towards additional stimulus for Germany. And on top of that, that stimulus is expected to be used not just in broad stimulus for the German economy, but specifically for defense. So again, the signal that the euro area is getting ready for potentially more tensions, whether it's with Russia or with the United States, hopefully remains on the commerce end, if that. But I think the big picture here for Europe, I'll just wrap it up on at least this economy. I think policymakers have known for a while that this would be coming, these threats from the United States. The EU does have a large trade surplus with the United States. We know that that's something that the US administration is watching very closely. And in fact, that surplus is larger than both Canada's and Mexico's, and it's only behind China in size. So that said, the Euro area countries together do have a much larger economy altogether, and therefore a larger capacity to retaliate than Canada or Mexico do. And finally, I will also just point out, because again, there is a lot going on here, the UK does seem to be avoiding the US's crosshairs for now. The UK is actually in a trade deficit with the United States. So it has largely flown under the radar, and the Prime Minister seemed to have had a relatively positive meeting with President Trump last week. So all of that to say, again, as we look ahead to the possibility of potential universal tariffs or so-called reciprocal tariffs coming out of the United States, I think the bottom line here is that more countries are covered. The more countries that would be covered, the harder it would be for companies to avoid these additional costs. There's only so many places you can go to hide. So again, just to wrap things up again, I think the countries that have trade surpluses with the United States should be and are already preparing for some kind of action from the administration. And some of this, I think, is just a matter of the size of the surpluses as well as geopolitical dynamics. And so China, we find, is at the top of the list in both aspects, which is kind of why we're seeing just so much attention on it right now.
Excellent. Thank you, Shelly. I was thinking as you were setting the stage there and really setting the placemat, I was just thinking of how much complexity is in the system right now. And I can't help but think the best thing right now for business owners to be doing is just really highlighting and magnifying those best practices in an uncertain environment. And I think that just kind of focuses why work like this is so important, and to make sure we're digging deep into those conversations. Swaroop, I was thinking about a conversation we were having where we were helping out a customer, and I know your guidance on China has evolved a little bit. So maybe Swaroop, over to you in regards of how you're guiding clients right now as it relates to China.
Yeah, as we all know, China is obviously Canada's second biggest trading partner behind the US, and so that's going to stay or even solidify given the environment that's happening in North America. The interesting thing about China and just generally Asia is that since the cost of capital there is higher, they use a lot of trade finance products. There's a lot of non-funded products that they use, and clients have been seeing a lot of working capital issues as they switch or they start talking more to Canadian or to Chinese customers and suppliers. And so some of the things that we've been having conversations with clients are really around how to bridge those working capital gaps. And one of the things that we've been talking about is obviously using more letters of credit, using solutions that would be able to get them cash faster into their books and hands, and also using various supply chain financing tools to really leverage sort of the customer base that's out there in China. A lot of the clients that we're talking to are, really surprised when we say that we are one of the Canadian banks, or we are the only Canadian bank to have a domestically incorporated subsidiary in China with full service capabilities, the entire product suite, including general banking and trade finance and the suite and the like. That also helps us, have strong ties with banking partners there in China. So any goods that flow across, any transactions that we're supporting across Canada, China, we're able to support we're able to support end to end. So that's, we're able to add a lot of value from that perspective. And we see that is pretty much going to keep being center and focus going forward.
Excellent. Thank you, Swaroop. I really appreciate the insights. I'm going to try Jason again. I believe his audio is working. So Jason, I'm going to start at the top of the conversation, where I was really wanting you to kind of step into the shoes of the Canadian importer and digest some of these implications for them. So Jason, we're going to give you a shot. Over to you.
Sure. How does this sound? Is this better?
Crystal clear. It's a beautiful voice.
Perfect.
Go ahead, Jason.
All right, great. Yeah, sorry about this. Amazing what a restart will do here. Yeah, I mean, as I was kind of saying before, that right now the U.S. dollar, the strength is really hitting the importers very hard. We've seen a 5% appreciation in the U.S. dollar since the U.S. elections. I know Shelly was mentioning earlier, if we're to see these 25% tariffs on an ongoing basis as a lasting sort of thing, we're looking at $149 to $150 Canada is kind of the number she threw out, and our chief economist Doug Porter said the same thing yesterday. That's a 9% appreciation in the cost of goods sold if we get there for an importer. If you want to go worst case sort of scenario, then back in 2001, we got up to 162. That would be a 16% appreciation in the U.S. dollar. As those start to build, it really starts to hit a U.S. importer, and the thought starts to be, am I able to pass on those additional costs to customers? So it's very tough right now for them, and we're having lots of conversations as to ways that they can manage that risk. People are getting very concerned, in addition to the currency appreciation, we're talking about a 25% tariff hitting that as well. So an importer's buying a good, now it costs 25% more than it did in the past. And then add on top of that a 16% appreciation in the US dollar. If we were to talk about, $162 Canada rate, we're talking about a compounded increase in cost of goods sold between 40-45%. I don't know many importers that are able to pass that on. And then adding kind of to the fears, and Shelly mentioned it earlier, the volatility that we're seeing in the markets. Clients are really getting worried. I mean, we look back at what happened on February 3rd. We had a 4-cent jump in the dollar Canada currency rate, or depreciation in the CAD, in a matter of hours, and then a 4-cent retracement. So that's a 4-cent up, 4-cent down move in the dollar Canada currency pair in a matter of hours. To put that into perspective, we look at just last year, the entire trading range for the dollar Canada currency pair up from the start of the year to the U.S. election was a little over 6 cents. So we did 4 back and forth, literally in a matter of hours. So that sort of volatility, along with the potential that we could see further appreciation in the U.S. dollar, to a significant extent, is really concerning U.S. dollar importers, and we're having a ton of conversations right now on the topic of risk management as companies start to be concerned about how are we going to be able, if we do go to 150 or 160, what is my profit margin going to look like? Are we going to be a going concern? So risk management is a huge topic we're speaking with our importers about at this time.
Thank you for the perspective, Jason. Really appreciate it. As I was listening to you, the one thing I was thinking was the materiality to the ranges that you put forward, and you combine that materiality with the volatility that we're seeing. So what are some of the tactics that we're using right now to help our customers and business owners to manage that risk on the import side?
Yeah, for sure. I mean, as I mentioned, a lot of the importers are really scared right now. And I've actually had importers say, I just want to sleep at night. I don't want to have to wake up at 3 a.m. and worry, what did Trump tweet? What's going to happen? If we go to 150, what's going to happen with my business? And I mean, there are a lot of ways where you can protect your business against an appreciation or a rapid appreciation in the US dollar. I mean, the simplest and most basic way to do that is just a basic forward contract. I mean, lock in the current exchange rate to use in the future. I mean, it kind of sucks to be buying US dollars at 143, 144 from a historical perspective. But if you're worried about us going to 150, or you don't know if you're going to stay in business if we go up to 160, locking in at 143, 144 is not really a bad idea. And a little ray of sunshine on the back of that is the fact that the dollar Canada currency pair is trading at a fairly deep discount in the forward market. And what I mean by that is if you're lock in a rate to purchase US dollars in the future, you're actually locking in a rate that's better than the current spot rate. To put some numbers around that, if you were to lock in a rate to purchase US dollars each month for the rest of this year, you'd be looking at a rate about a penny below where the spot rate is trading. If you hedge a bullet out 1 year from today, you're looking at about 2 cents below the current exchange rate. If you did 2 years from today, you're about 4.5 cents, locking a rate 4.5 cents cheaper than where it's trading right now today. So, I mean, to kind of combine the two, if you want to sleep at night and just get rid of all that risk, locking in, a current exchange rate, so that you know what your costs are going to be on an ongoing basis, it's definitely not a bad idea.
I love that message and that tone, Jason. Just again, anything to reduce the risk within your business model right now. And I think there was a time and place where people would say, well, I don't actually have to use some of these fundamentals because the volatility or materiality, sometimes I gain, sometimes I lose, but it's a wash by the year end. But when I hear those ranges and that volatility, I think it's a different dynamic, and the importance of those fundamentals are just so key. Jason, I'm going to keep on focused on you, and I wouldn't mind you kind of going into some of the currency dynamics that will impact the exporters as we kind of play this out.
Yeah, from an export perspective, I mean, there's similarities and there's differences. There's obvious difference being exporters love a strong U.S. dollar. So, hey, I mean, the market has definitely moved in their favor nicely here. You're talking to people are throwing out numbers 149, 150. Hey, that's great for them. The concern on the exporter side is a little bit different in the fact that they're worried more on the demand for their goods than they are on, the currency fluctuations actually impacting their ability to do business. And by that, I mean, if say we were to go to 150, or even if we were to go to 162, I mean, 16% appreciation in the U.S. dollar since Trump was elected. For an exporter, that's great. They're getting 16% more Canadian dollars per U.S. dollar of receivables. But, if they're getting hit with 25% tariffs, what does that do to the demand for the product? Does that go down by 25% or more? If they lose 25% of their business, having a 16% appreciation in the US dollar, it helps offset it a little bit, but it's still, not great. And so the conversations that we're having with US exporters right now, I mean, in terms of similarities, is the uncertainty again. Nobody really knows which way this is going to go. It'd be terrific for them, if we were to go higher and it didn't have an impact on what they're selling or the demand for their products. But, you look back at the first Trump term, we spent the vast majority of the first Trump term, dollar Canada trading between 125 and 135. I mean, more than 10 cents below where we are right now. It only kind of spiked up after that when COVID hit. And that was kind of unrelated to kind of economics, really. It was just kind of the fear of the world shutting down. So, I mean, if your thought process is that, cooler heads are going to prevail in this trade war and, we're going to go back down to a more kind of normal level for dollar Canada, you could be looking at a 10 cent plus depreciation in the US dollar, and you'd be kicking yourself if you didn't lock in selling US dollars north of 140.
Yeah, absolutely, Jason. I appreciate this perspective because, again, it just highlights the importance, because we talk about this in a broad base and it could be less actionable when you come directly to your own business. And I think it just highlights the importance of making sure that we are always open to have that direct conversation as it relates to you and your business, either on export or import, on how Jason and others within the subject matter experts at BMO can help you. So I really appreciate that, Jason. I'm going to start working on kind of bringing all this together, and I'm still thinking about Shelly, who hasn't slept in a week, and maybe just to kind of ease and lower the temperature for everyone. And maybe, Shelly, I'm going to go to you. And are there any dates that we should be paying attention to, or other things that you're thinking about that are going to have a material impact? And I don't want to say, even though it's in my notes, the next shoe that's going to drop. I just feel that it creates more anxiety. But the next thing that we should be watching out for, Shelly?
Well, literally the next thing is this afternoon, when we could see a positive development in the form of this potential 1-month reprieve for Canada and Mexico. So this afternoon, yes, but I think we're starting to realize that this is a situation, because it's so fluid and dynamic. No matter how many times we've said those words today already, we kind of need to keep an eye out all the time at this point. That said, we of course do have a number of dates that we're circling. So We could see additional tariffs this time on steel and aluminum products that could be in place as of March 12th. Now, these would apply to all countries, and I will note that these and any other tariffs are expected to be cumulative. So, for example, if we're in a situation where we still have 25% tariffs and 10% on critical minerals, this would be added on top of that. Then we've got the reciprocal tariffs in early April. So the president has mentioned both April 1st and 2nd, which is also when, if we do get this reprieve this afternoon, that is about when that reprieve would end. So again, we could be back to 25% plus this additional steel and aluminum, plus potential reciprocal tariffs. Now, we don't exactly know what reciprocal tariff means at this point. They're kind of meant to be broad in the fact that they could, I shouldn't say fact, in the possibility that they could be imposed on pretty much any country that the United States trades with. But they are also meant to be applied on a country by country basis. So it could look very different depending on who exactly you are and what your domestic tax situation looks like. We also have additional threats on specific industries. Just highlighting off the top of my head is really lumber, autos, ships, semiconductors. So some sectors that are quite significant here in Canada. Now, I will say that just given the scale of these potential tariffs, it's very possible that they're announced in early April, but they don't come into effect for some time after. We've seen a number of estimates for even a few months or 6 months after. So again, it's really about keeping an eye out at all times, really. Now, also happening in the background, while all of this is going on, Canada will get a new prime minister. The Liberals are electing a new leader on March 9th, which is the Sunday soon after that. Don't exactly know when. After that, the prime ministership, if that is the word, will officially change. And Canadian Parliament will resume on March 24th. So both of these things could change the context of any negotiations and any tariff support measures on Canada's side. We're also keeping an eye on fiscal developments in the United States, just given the immediate urgency of that fiscal problem and the administration's hope that tariff revenue will help. So the federal government in the United States does face a shutdown again in mid-March unless another continuing resolution is passed. We have seen this the cycle repeat itself for a number of years at this point, but I will just highlight that as a possibility again in this tariff context. So I'll leave it at there for now, but really it's just there is no shortage of excitement right now.
Yeah, thank you, Shelly. And there's a lot of different angles and industry elements there. And I will highlight underneath BMO, we have industry dedicated experts, and then we have a lot of thought leadership that you'll have access through your relationship managers. This is one piece of the puzzle. And Shelly, I think you've set us with the perfect kind of placemat as we kind of investigate all the nuances in this. Jason, I'm going to bring it to you. And, as we kind of wrap up the conversation, maybe just overall guidance to clients as they look and manage their FX risk in this environment. What's different at this time of this year compared to last year? Tips, tricks, tools that they should be seriously considering when they look at their business. Jason, over to you.
Yeah, I mean, what's different this time or at this point in time compared to a year ago? I mean, the uncertainty is significant. The volatility is significant. I mean, everything has kind of changed around, the dollar Canada exchange rate, and importers and exporters are kind of both in the same sort of situation where we don't know what things are going to look like. As Shelly said, an hour from now or tomorrow or next week or, let alone a year from now. So, I mean, risk management is there to help you sleep at night, to protect yourself. I mean, from both an importer and an exporter perspective, you should be looking at putting some sort of risk management policy in place from your currencies if currencies have a major impact on your business. And we have people across the country who are currency experts and currency risk management experts. And it's our job to meet with clients, learn about their exposures, learn about their budgeted rate, what is their risk tolerance, and currency hedging can be very boutique. We can specifically build a hedging strategy that meets exactly what a specific client needs, whether it's an importer or an exporter. I kind of meet with a client, learn about their business, and what I'll usually do is put together a couple different ideas based on the current client situation. Say this is something that other clients in similar industries and that have similar exposures are using to manage their risk. Let's talk about these. Which one of these makes most sense for your business, if any? And I can kind of tinker with it to make something specific for our clients' needs. So my recommendation would be don't hesitate to reach out to us. We have the expertise in-house at BMO. If you do have currency exposure and you want to talk to somebody about that and talk about minimizing the risk in an environment where there is so much uncertainty and volatility, we're here to help.
Excellent. Thank you, Jason. I love that sentiment, and I think it is that simple. We're here to help. Swaroop, I'm going to look over to you. How about you? What is the one thing all of our clients should be thinking about doing in the current environment?
Yeah, uncertainty obviously is the name of the game. That's going to stay on for a while. But I think what we're advising clients and having conversations with them is that this is an opportunity. Look at this as an opportunity to look through your supply chain, to look at your supplier base, look at your customers, find ways to drive efficiency out of those. As you onboard new clients, as you look at new jurisdictions, as you look at new suppliers, think of BMO, think of us. We have a diverse product suite that can help you in these conversations, can aid you with the tools that you need, and we're here to listen. Right, we're learning as we go as well. There's a lot of things that are uncertain. There's things that will change by the minute, by the second. We're here to listen and obviously provide a helping hand as you go by. So take that away, and we're here to help.
Really appreciate that. I appreciate the positivity and the humility there. There's thank you, Shelly, Jason, Swaroop. Just such a privilege to having access to you 24/7. But Shelly, seriously, you should probably get some sleep in the current environment. We all should take a pause and look after each other and ourselves in the current environment. At BMO, we have a responsibility as your financial partner, and that's simply to be there for you. We have world-leading research and expertise, and it's at your disposal. Reach out. I have two things. Reach out to your relationship manager and make sure that you have access to the thought leadership, nuances around industry that are specific to you. This is one piece of the puzzle. And quite frankly, today was really about the tip of the iceberg. We're going to have several sessions unfolding, and I would love it if you provided feedback directly to me, to your relationship manager on how these can be better, more relevant, and how they should evolve for your benefit. That's key for us. And the other thing I would just highlight, our online banking for business platform has a tariff hub in there for you to keep you most up to date on key dates, information, and what's happening. It's your resource. It's for you to use and leverage as you manage the current environment. And as always, just a huge thank you. Thank you for your trust. Thank you for your partnership. We'll be here. We'll be here as you need us, and looking forward to that conversation as it unfolds. Thank you for taking the time. You have a great day. Thank you.